There we go. Good morning and welcome to the Oklahoma City MAPS Investment and Operating Trust meeting for November 18th, 2024. So moving on to item 2, approval of minutes. Included in your packet were the minutes from August 19th, 2024. Are there any changes, revisions, corrections? If none, I take a motion in a second.
Waiting.
1 minute. Technology is drowsy this morning.
Well, I was up at 5:30 to cancel school.
Yeah, I was going to say, what is the deal with our Monday morning weather? This is 2 Mondays out of 3. Okay, here we go. All right. Cast your votes. Motion passes. Thank you. Moving on to item 3, items for individual consideration. And if you would be patient with us, we've got one of our presenters that is stuck on the highway, so we're going to move things around a little bit. So we're going to move to item 3D, presentation and proposed distribution of funds for the MAPS Senior Health and Wellness Centers. And we have with us Melinda McMillan Miller from the Parks to present. Good morning.
Good morning. Thank you for letting me start a little earlier. I have an appointment I need to make before 11, so I appreciate that very much. Again, I'm Melinda McMillan Miller, the Director for Parks and Recreation. I wanted to come before you today and just literally just inform you of how we've come up with a matrix to distribute what we feel is an equitable way to distribute the trust funds to the Senior Health and Wellness Centers membership in order to support those low-income seniors. Maybe I have, I do, there he goes. Okay, so as you guys all know, with the MAPS 4 resolution, the intent was that we support those low-income seniors who otherwise may not be able to access or have the availability to have a membership in one of the 4 senior wellness centers. The forecasted amount for that trust is expected to be about 4% of the market value annually, and at this point, on the last report that we had was about $600,000 by 2026. Of that $600,000, that is how we will, the funding that we will distribute initially out of this trust investment. So in order for us to kind of come up with a matrix, we utilized information that we had from a 2022 PROS Consulting report that really focused on our senior centers themselves. And that data they used was from ACS, ESRI, and other Bureau of Labor Statistics. From that, the demographics were analyzed within a 5 square mile radius of each center. Within those, they analyzed how many of those population households were low-income senior households. From there, we did a lot of math that I'm not great at, but from those numbers, we calculated the percentage of low-income senior households by each center, and from that, then extrapolated the annual distribution to those centers based on that percentage of low-income households. And that gave us the annual number of memberships that we can actually distribute. Here's a chart that kind of spells it out a little bit better than I can actually verbalize it. So for each center on the left, you have the Rockwell, Pete White, North Lincoln, and Southwestern centers. And at the bottom line there, you'll see the total number of households that are over the 50 age range that are considered low income. So a total of 39,809 total households. Those are broken out by the actual number of low-income senior households per area. Then, of course, you extrapolate to the percentage. And from there, out of $600,000 total distribution, 16% of those households for Rockwell would receive, or the center would receive up to $96,000 for memberships, $228,000 for Pete White, $180,000 for North Lincoln, and $96,000 for the Southwestern YMCA. That is then divided into the average of $35 per membership per month is the cost for our senior centers. And then, of course, that's per month. So then we divided it by 12 again for the number of memberships per year. And so then you'll see that 228 memberships can be made available for Rockwell, 633 for Pete White, 600 for North Lincoln, and 186 for Southwestern YMCA. So for a total of 1,647 memberships. What's also important to note is that the 5th MAPS Senior Wellness Center is expected to start construction about 5 years, maybe 6 years. It's quite a ways out on the plan for MAPS 4. When that occurs, we are expecting that the balance will continue to increase. The corpus will increase in amount, and that we will redistribute the full number of memberships spread out to each center when the 5th one comes online. But we're not expecting it to affect it too much or too greatly, the number of memberships, because of that increase in the corpus. So how we plan to distribute it to the actual facility operators is that the operators will request a reimbursement at the end of their calendar year. So we would have received that report from them hopefully January or so, after their calendar year has concluded, showing us the number of low-income memberships that they sold that year. Based on that request, we will submit, those requests will come to my department. From there, we will submit that to Treasury, asking them for the disbursement. The council would then approve that disbursement before the end of the city's fiscal year. So sometime in between March, May, June, before the end of the fiscal year. And then that reimbursement would be sent to those operators in early July of the new fiscal year. So we're going from calendar year to fiscal year, kind of balancing it back and forth. But that was the recommendation that we received. That's a lot of information to speed through, and I'm sure you have questions, so I'm happy to answer those.
Questions?
I do have some questions.
Yes, please.
I should know the answer to this, Melinda, because I am a member of the Southwestern facility. But so you're proposing, or someone is proposing, that the low-income price be $35, is that correct?
That's correct.
And how does that compare to the full cost? What is the full?
Right, so the YMCA Southwestern is a bit different in their membership structure.
Okay.
So the other 3 centers, a full membership price with no deductions is $35, and that is actually the cost for the membership to the centers. So even though some memberships may only cost them $5, the membership cost to the center is $35.
Got it. So,
Right.
so you're not saying that the participant is paying $35?
That's correct.
So how will that rate be set up? Will it be a sliding scale? Is it a flat rate?
Right, each of the centers have a sliding scale for income.
Okay.
And so based on their sliding scales will be $5 to $10. Most all of them are $5, the base low income rate. Some of those are also compensated from either like silver sneakers or other insurance programs that they have, they've been subscribed to. A lot of the time though, like with the YMCA is a little bit different because the YMCA offers their membership spread across their whole YMCA network.
Right.
And so their membership cost, their average membership or full membership price is I think 48 or somewhere 49, 50,
I
somewhere.
wanted to say 50 something.
Yeah,
but
some are right around there, so it's a little bit higher. But I consulted with the YMCA director and talked him through this process and this procedure, and he acknowledged that that was still to keep it equitable across everything and try not to have too much, because what would end up happening is that we would have to offer less low-income memberships to the YMCA versus the others. And so we're trying to keep a even-keeled reimbursement opportunity for everybody.
So the other thing that it just seems to me like the operators will struggle with it, only an annual reimbursement. Has there been any consideration to a more frequent, quarterly, semi-annual? I mean, that just seems like a lot of burden to carry for a long time.
Right. And when we consulted back with all 4 operators, and they were all agreeable to this kind of distribution.
Okay.
So they did not have any heartburn about it. One of the things too that we are hoping to be able to improve this now, and so that at the end of this current calendar year for those centers, they will have, already had this burden, if you would, and then we would be able to reimburse them next year. So we're already in that at the end cycle, but yet they've already been operating for the year.
Okay.
Yeah.
Those are my questions. Thank you.
Thank you for your question.
Jessica?
Melinda, I just wanted to express my sincere condolences to you. I know you have to leave to get to a funeral, but Brenda Castro was such a long-time employee of the city of Oklahoma City, and I just wanted to express my sincere condolences to you and your staff.
Thank you very much. I won't cry.
Any other questions?
Okay.
So I don't mean to be the slow one,
That's okay.
but so as I'm understanding as you're describing, so different centers, so even though they may have a sliding scale for memberships, so that they may, currently a low-income senior may pay $5. What your plan is that we'll reimburse them for the full $35.
That's correct, because that is the center's operating cost to support that senior's membership.
Okay, and what is the, do you know off the top of your head, maybe you don't, the AMI percentage that's the determinant for low income? Or is that where the sliding scale comes in, or?
I am not sure what that is, honestly. And each center kind of has their own, but I believe, and Brent may be able to correct me if I'm wrong, but I believe that with those centers, they determine, I think it's 30,000 or 50,000, 30,000? I can't remember what the AMI is. I thought it was $30,000 or less per year.
Okay.
Is the senior
So that would
level,
be
but I'm not
50
exactly
to,
correct.
50 to 60% AMI, I
Yes.
would guess. Okay.
Yes, and I can get you the actual exact number.
Yeah.
I can email you.
Okay, yeah, that's fine, that's fine. Yeah, and then I'm thinking because I'm assuming the goal is as the fund increases and the cost of those memberships increase, that it'll kind of, that'll mirror that.
We think it will average or
Yeah.
mirror. The centers have only risen the membership fees from $30 to $35. And that was actually initiated by Healthy Living since they've opened. And so it's been 10 years since Healthy Living's been open. They've only raised it $5.
Okay, okay.
So
yeah.
another consideration too is that as the centers, as they do adjust, they call our department, we talk them through that, understand what that is, let the city manager's office know if there's any issues that they would see with that. But normally those rates are also approved through the city manager's office and the council.
Okay. And then I'm thinking, as that fifth wellness center comes on, we'll be able to do this calculate. I guess as we've emailed about this, my concern is that when the fifth one comes on, if there's a dump, if there's a significant decrease for any of the first four, I don't want to damage, to hurt those centers or the people they're serving. So I'm thinking that probably we'll know a couple of years before and can do this calculation and give the existing four some what the anticipated reduction or leveling or whatever that looks like. So just don't want to set everybody up for success.
That's right. And what we're hoping to do is give a report or an email out to all the operators at the beginning of our fiscal year or even calendar year, whichever one they prefer, to let them know that this is the expected disbursement.
Perfect.
And that way they can plan and their operations and their budgets. The other side of this is that we will recalculate about every 5 years that population service radius. Between the Bureau of Labor Statistics, we'll be able to do that. So if there's an increase in low-income households in that service area within those 5 years, then we will adjust. The other part of this is that if a center did not request their full disbursement, but another center requested and had more, we will be able to shift funds around. So it's not going to be a guaranteed solid dollar amount every single year, but we'll do absolutely everything we can to help them with all the disbursement we can possibly give them to help seniors get that membership.
Yeah, I love that. Thank you. One last thing, and I don't know, Matt, if this would just be a written report or if Melinda wants to come see us once a year, but I think it would be interesting for the trust to kind of get an update on what numbers were served and that kind of stuff.
We'd be happy to do either way.
Okay. We're a
happy to
pretty
come.
friendly group, so, okay.
Yeah.
We know you have to be somewhere. We are truly
Yes.
very sorry for your loss.
Thank you very much.
Thank you for being
Thank
here.
you.
Okay.
Right.
Any other questions for Melinda? Okay. All right.
Thank you.
Thank you.
Appreciate your time.
You bet. Thank you for putting this together.
Oh, I just appreciate you letting me go early.
Okay, moving on to item 3A, receive general manager report for the period ending October 31st, 2024. I believe Matt Boggs is going to present.
Absolutely, and good morning. And I think it's great timing to having Melinda here to present that, because if you look at the agenda and you look at the activity that we have, it looks like there isn't a lot going on. But there is a lot happening behind the scenes. We've had multiple of the operators reach out to our office to see what the distribution process is going to look like. And so over the coming meetings, we will see more and more activity coming through. And so while we are still with just the one single $159,000 disbursement that has been made, expect that number to increase. We won't steal too much of Doug's thunder, but we've had a healthy quarter our investments have performed well, and we're maintaining that healthy amount, which is going to be good going into 12/31. Because if you remember correctly, when we calculate our fiscal year 26 disbursement, it will be based on those 12/31 numbers, looking back at the previous 3 years. And so having a strong into the calendar year will be significant for these amounts. But we do, just kind of piggybacking on what was said earlier, yes, the plan is to have some of these operators come in just to give you an idea of what sort of things are happening, because you can see it's a range of complexity when you start looking at income and that sliding scale for the parks, and youth centers will be something very similar when that comes along to some of these other types of projects and what they use the funds for. So it'll be something that for informational purposes that we'll bring before the trust. Any questions you might have?
Questions? Brent, I feel like you've got a question. You're giving me the look.
It's we've been through so much with this trust, and it's really nice when you do look at the general manager's report and see that we're $19 million over the corpus. That just, I think we can all sleep better knowing that we can provide assistance to these programs, and it's just really exciting to see this, because Lord knows it wasn't that way in the beginning. So
No, it wasn't.
oh, it's terrible. So, but yeah, it's really great news. So good job, Matt.
And from a management standpoint, it has been because of the 2% that was approved for the disbursement for this fiscal year. That is under what we keep liquid in our money market. So we didn't have to adjust our investments at all, because any disbursements, we already have that amount liquid. So it makes it fairly easy, especially in these first years as we're figuring out how all this comes about.
Yeah, good. Any other questions? So my only question is, when we first kind of talked about our process, we had kind of lined out a timeline where we would kind of, to your point, look at what that calculation is probably at our February meeting, and then notify so that organizations, beneficiaries would know before the end of the fiscal year, before, kind of in that early June timeline. This year being our first year, we were kind of figuring it all out. Do we think we're going to be able to get on track with that schedule again, or do we need to revisit that schedule?
I do think we're going to be able to get on track with that schedule. We are in constant communication with the city partners,
Okay.
and one of the things that we are making sure is that everyone has their operating agreement in place between the city partner and the operator. And so what that allows us to do is to approve it, and so there's not as many steps that happen in between. And so we're in communication there, but a lot of the operating agreements in the weeds, that's where those
Kind of
the
slowed
activities
down a little
happening.
bit. Okay.
Yeah.
And so what I'm hearing you say is that the trust communicates with the city department communicates with the beneficiary, then the beneficiary. That seems like a lot of bureaucracy, but maybe we can find some efficiencies moving forward. But I understand having to get the operator agreement in place.
Yes.
So that we, legally, right, have a mechanism to make those disbursements. So, any other questions? Yes?
There's some construction going on with the building, and so from time to time you may hear noise. I don't think it's anything serious. And
Okay.
the big construction hasn't even started yet. So,
Oh, goody.
yeah.
Okay, Matt, thank you so much.
Thank you,
Appreciate you
and
being
I
here.
will-
Okay, and we do need to vote to receive Matt's report. Need a motion in a second? I-
I don't think so. I'm pretty sure my phone will go. So.
It's coming. There we go. Please cast your votes. Okay, the motion passes. Thank you. Okay, let's move to item 3E, renewal number 4 of the custody account agreement with BOKF. And this is our custody account with estimated cost of $50,000, retroactive to November 15th, 2024 through November 14th, 2025. This is just a standard renewal with all the same terms. Any questions?
No, it's a typo.
It's a typo, so, okay.
That's pretty minor.
Yeah. Okay, please cast your votes. Okay. And I think we can go ahead and take care of item 3F. Oh, whoops, motion passes. Thank you. Go ahead and take care of item 3F, receive calendar year 2025 meeting schedule. You see there the 4 dates for 2025, February, May, August, November. If there's any questions? Otherwise, I take a motion. Okay. You guys are fast. Please cast your votes.
We can tell you're ready to move along.
I'm trying to give Doug time.
Let's take your, okay, let's be slow on the next one.
Be slow on the next one. So, motion passes. Item 3G. Okay. We need to ratify claims from August 13th, 2024 to November 12th, 2024. There was only one claim for $10,863, and that was for payment to the custody bank for services rendered. Okay, please cast your votes. Okay, with that, we'll get an update on our presenter.
Yes,
Motion
live
passes.
traffic updates from here. Doug is about 15 minutes out. As the investments is key to this, I guess my proposal would be we take a 15-minute recess and come back to hear Doug's report.
Do we need to vote on that?
Hey, if I leave, do you still have to be up for?
Yes, we do.
Okay, because I'm gonna go up here.
Okay. Do we need to vote on that?
So you can just announce it.
Okay. Okay, we will take a recess for 15 to 20 minutes until our presenter arrives.
Thank you.
Okay, thank you.
Have fun this morning?
Not a lot of fun at all, actually.
I empathize.
Thank you.
Taking out my extra closet in a hurry this morning. I'm ready.
All righty, we will reconvene our meeting and move to item 3B, to receive our quarterly investment report for the period ending September 30, 2024. Doug Anderson is here to present. Good morning.
Good morning.
Thank you for
It's
all
been
the
an
effort to get here.
It has been an eventful one. Normally, it doesn't take me 2 hours and 40 minutes to get here, but today was different. We're going to go over the September 30 report. I'll do an abridged version in the interest of time and leave time for questions. Am I running this, Sean? Okay. So market environment, I will say this, going through September 30, inflation was an issue. The Federal Reserve lowered interest rates. Economic growth in the world was uneven a little bit, but when we look at performance on this slide, you can see that returns were quite strong. The S&P 500 was up 5.9% for the quarter. Small caps and mid caps actually did really well. I'll point out why in a moment here. You can see international equities also, great returns for the quarter, and fixed income came in also. So this is one of the first times in my somewhat cloudy recent memory that everything performed positively both for the quarter and for the trailing year. And if you look at the bottom column, you can see just how strong returns have been. S&P 500 up almost 36%. The other large cap index is the same. Mid caps and small caps didn't keep up, but the main reason why is the so-called Magnificent Seven, right? The big mega technology stocks that led the way through most of the year, but you'll see going back to the top chart there that they did, although they performed well, they were outpaced by mid caps and small caps. So we're seeing this uneven rotation amongst growth and value, large cap, mid cap, small cap. But thankfully, all parts of the portfolio were positive for the quarter and for the trailing year. I'm going to go to the growth and value. On this, the top chart is the quarter. The bottom chart is the trailing year. And you can see that on the top, value stocks actually outperformed for the quarter by a fairly decent margin in the large cap area. But then when we go back down to the bottom, while it gets closer and closer as you go from large cap down to small cap, where the returns are pretty close to one another, large cap absolutely was favored on the growth side of the market. Now, here's an interesting slide, and I think it tells us a little bit about what's going on in the world that isn't immediately apparent. But you look at the top chart. So this is Russell 1000, the 1,000 largest stocks traded in the United States. And there are two columns for every one of the sectors there. The dark column in each pair is the return for the quarter. The 1 year is the lighter blue column. And as you go, you follow the list down, I think that communication services, that's part of the technology complex, 42% over the last year. Kind of have that one figured out. Financials, very good, 39.7%. Information technology, 50%. But there's one just below that, it's the very bottom set, that's utilities. Those usually don't perform with the technology stack. And the reason why is, I'm sure you have seen it, is that electricity is very much in demand right now. About a month and a half ago, I read a news story, a headline I thought I would never see. 3 Mile Island nuclear reactor is being reopened, not the one that melted down, one of the other ones, to provide exclusive power on I think it's a 20-year agreement to Microsoft for a data center. It's not on the property, but it's adjacent to it. And then last week, which even boggles my mind a little bit more, is Diablo Canyon nuclear reactor in San Luis Obispo, California, which was slated for shutdown, is actually not going to shut down because NVIDIA is actually co-locating a data center on site. So you're talking about California saying we're going to go ahead and reopen this. So it's been a very interesting environment. I have clients who are utilities, and they say that their phones have not rung this much in decades, literally. Electricity, the demand growth in the United States has been about 1% per year over the last 20 years. It's going to be 3% this year, and it's going to be 4% next year. So it's a race, and it's not a race for megabytes. It's a race for gigabytes. These data centers are so amazingly power hungry that anything else out there, electric cars, rounding error. All of the electrical demand, and they want it from every source possible. So the grid will be strained, but you can see that utility companies are able to charge a premium and get very long contracts with these data centers. So that part of the energy supply chain is very much reinvigorated right now. And again, like I said, you don't see utilities performing as well as the tech sector when they're going up. Usually they diverge, right? Utilities, because that's the big picture there is because energy demand has been relatively stable in the United States, but we have a hockey stick right now. Going into the largest companies here, you can see Apple, Microsoft, NVIDIA, Amazon, Meta, Alphabet. You have to get down to Berkshire Hathaway before there's any of these companies that you would say are not involved in the high tech and the AI sector in one way or another. And you can see I'm still astonished. NVIDIA has been an amazing story for the past 2 years, not quite 2 years, about 17 months. But even over the year ended September 30th, for the trailing year, it's up 179%. You honestly, unless there's a complete change in what the economy is favoring, you don't see companies this big providing that large of a return. It's very tough for active managers to keep up with that because they can't weight NVIDIA as high as it is in its index in Apple and Amazon and Microsoft without getting up against standard position limits by policy. International equity has been great. You can see for the trailing year, we haven't seen returns like this in some time. I have clients who are continuously, almost every quarter, asking me, domestic equity looks great, what's wrong with international equity? So we are starting to see some change here. Although I expect growth rates in Europe to remain a little bit lower than what we're seeing in the United States and East Asia also. All right, let me get back to the condensed version. Bonds were positive. You can see that risk was rewarded. But over the past year, we have had returns and capital appreciation of the bond portfolio. Bond market is a little bit uncertain right now. As you see the yield curve on the following page, Federal Reserve has lowered interest rates twice. 50 basis points the first time, 25 basis points the second time. Inflation is not at 2% yet. That's usually the trigger when they start raising interest rates, and unemployment's about 4%. So to me, this is the first time I can recall the Federal Reserve actually trying to reduce interest rates in advance of an economic slowdown. If you remember last year about this time, the bond market was expecting a slowdown this year. They were expecting 7 interest rate cuts in the year 2024. We've had 2, and they happen in the second half of the year. So that will be an interesting part of the market to be observing. The long end of the yield curve, if you've been in the business for close to 30 years. You remember a term called the bond market vigilantes in the Clinton administration. They were pushing a lot of fiscal policy, and the bond market said, "No, this is going to be inflationary." Sold off bonds, interest rates rose, and that has its own effect of slowing economic activity. Let's see. Let's go to the portfolio. So we go all the way back to February of 2022. And we all remember how we were under principal, underwater for some time, even going back to about this time last year. But since inception, we're up 16%, or 15.99. Capital gains of close to $20 million, income of $7 million. And so now you can see that we have a gap in between the market value and the principal value. And I looked as of Friday's close, we're still about $134 million. So no significant change since the end of the quarter. This is an interesting chart. We did take a temporary move to reduce the amount of equity exposure because we were very uncertain. But I will say that the timing of increasing the equity exposure back to its target level was phenomenally fortunate. You can take that anyway. That might be a euphemism for lucky, but I will take it. And we did have to have conversations saying, can we absorb more of this volatility? But I'm thankful that we reverted back to investment policy and said, let's go with it. Time will tell. Over the long term, you have one negative year in the equity market out of every 3. So I want to congratulate the board on making a difficult decision with courage and going back to the investment policy. Here's our asset allocation. You can see not much change, $8 million in increase during the quarter, 46.5% in domestic equity, 42% in fixed income, international equity at 8%, and the cash composite still at 3%. I'm in favor of keeping a little bit extra in cash because rates are still in the high 4s. And if we are paying out money, I'm sorry if I missed that part of the meeting today, but if we are spending money out of this trust on projects, I think a great place to park that is in cash if we have visibility. Here is our manager structure. I will say that it's very streamlined. I prefer streamlined. It is 100% liquid within 3 days. The largest allocation is the Fidelity 500 Index Fund. Then we have the mid-cap fund, the small-cap fund, and then the international equity. We have one bond vehicle in the core space, and then we have the high-yield fund at 5.7%. Not much change in the allocation during the quarter. When we look at this slide, it says that fixed income is a little bit high, and remembering that we have not filled out the alternatives in real estate, I think it might be time to start thinking about real estate right now. There's been a major change in the real estate market, starting to see some faint signs of recovery, and it's very uneven. The real estate market has changed from just 5 years ago. The trophy assets in the institutional real estate space were Class A office buildings in New York City, San Francisco, and those are not anywhere near full right now. So that is an area where I'm glad that we exercised some patience and moved on. You can see that that is the alternatives in the real estate. Those allocations are what is causing the overweight to fixed income, and I think it's a perfectly fine place to be.
So if we go into real estate, are you thinking maybe multifamily type?
I think a diversified portfolio, and given our size and given the ease of access, potentially a fund that holds REITs.
Okay.
Right? The REIT market has recovered much faster. Those assets are priced on a daily basis. I am challenged by folks who put a significant allocation in highly illiquid real estate. I think those terms are changing right now, and I think they're changing for the better. So it could be a partnership. There's a lot of friction. There's a lot of overhead that goes into going on those. I mean, the partnership documents, you're aware of how complex those are. So if we have to do that, then we can justify it, but if we can do a more liquid, simpler version, given the size of the portfolio, I mean, a 5% allocation is, $7 million. I think we can get the exposure easier than going into a illiquid private real estate fund. More to follow on that as we go through first quarter of next year and beyond. Here's the allocation. You can see appreciation on the top line, $7.25 million during the quarter, income of $883, and distributions, $159,000, almost $160. You can see the breakdown by fund below. And here's the big picture. As of the end of the quarter, market value broken down by asset categories, but the trailing one-year return is 20.01%. Since inception, we are up to 5.66% annualized. When we go down the list of one-year returns, the index funds are tracking near perfectly, and they're doing their jobs. All of them were positive, high double digits in the S&P at 36. Fidelity International Income, close to its benchmark. And then our fixed income portfolio, it's broken down into two funds, Dodge & Cox and the PGIM High Yield Fund, and both of those have done well. You see that we track returns out prior to the inception of our investment in it. These are the fund returns. But the Dodge & Cox is up 13.5%, 5th percentile ranking, and the PGIM High Yield Fund, one of the few that outperformed its benchmark over the last year, almost 16%, at 13th percentile. Again, trying to make this report in a condensed version, I'll go to fees. So the estimated management fees for the underlying investments is 20 basis points. That's incredibly inexpensive, and that's part of the design. We have active management across the board on equity, fixed income. It's odd to see your fixed income investments be the most expensive ones in your portfolio, but in this case they are. And I think the previous performance page shows that that's money well spent, outperforming the benchmark, outperforming most of the peers. So the total estimated annual fees is, for investment management is $270,000, $271,000, and that's 20 basis points. Very attractive. And with that, I will ask for questions.
Okay, any questions? No? Okay. If there's no questions, I would take a motion in a second to receive the quarterly investment report. Please cast your votes. Okay, the motion passes. Thank you. Moving on to item 3C, receive monthly investment report for August, September, and October. Doug.
So we're going to go to the October one. We've already covered the previous dates, and this will be quick. It was a negative month for the markets. I think that there's a lot of uncertainty out in the world, and obviously you can see the bond market is, during October, revolted against the Fed, sold the bond market off. The U.S. aggregate was down 2.5%, but we're still marginally positive for the year. Growth outperformed value on the year to date in all categories, but it's pretty narrow on the small caps and the mid cap and the heat chart. You can see the S&P 500 through the end of October is up 20.97. Again, not a bad year. And you'll see on the year to date, as we go to the left, communication services 31.3. And there we are with utilities, second best performer on a year-to-date basis. Again, not something that a lot of folks had on their dance card for this year, but it takes a lot to move utility prices higher, and I think that the market is really showing that that's a profitable place to be invested. Again, we had a slight downturn during the month at 132.5 at the end of October. Again, I said we're about 134 as of last Friday. And then the allocation, not much change at all. And as far as performance goes, while we're down 1.72 for the month, the trailing 1 year went down 3 basis points from 20.01 to 19.98. That means that the month we dropped off the end was a slight negative return last year. Again, no real concerns about the managers, very streamlined, very liquid, very low cost, and very effective at providing returns. So that is the monthly report.
Okay.
And again, I apologize for being late. It's a huge pet peeve of mine.
No worries. We worked around it and it worked out just beautifully.
I
So, no
appreciate it
problem.
very much.
Any questions about the October financials? Okay, if not, I'd take a motion in a second to receive the investment report for those 3 months. Please cast your votes. Okay, the motion passes. Thank you, Doug, appreciate it.
Thank you
Appreciate all
very
your
much.
hard work. Okay. So according to my agenda, I think we've covered everything. We're down to all of the discussion items, so we're down to item 4, comments from trustees, staff, and interested parties. I don't think anyone signed up to speak today. Okay. Anything from staff? Okay. Anything from the trustees? Okay. Since we're not going to see each other again until February, I would just say happy holidays, travel safely, happy new year, and see you in February. Thank you. Our meeting is adjourned.